It's Brian Preston, the money guy.
When you think about the difference in Ramsey Solutions and what they do, and the difference in us and what we do, probably the easiest way to think about that is through the systems we recommend you follow. Ramsey Solutions obviously talks about the baby steps, and we have a counter. We talk about our financial order of operations. If that's a new concept to you or new idea that you never heard of, go download our free deliverable. You can go to moneyguy.com/resources. You can actually see the 9 steps of our financial order of operations. And we even have a deep dive course that you can work through at learn.moneyguy.com, where we explain to you what this is and how it works and how you can implement it. I think probably going through the 2 systems is probably a great way to approach, okay, well, how do we think about wealth building differently?
I think, and this is one, if you're listening out in podcast land, I want to encourage you probably will want to come back to moneyguy.com and watch the video directly on our website so that you can actually see some of these visuals, because we're going to lay them right out on a visual. We're going to put the baby steps on the left, and we're going to put the financial order of operations on the right and compare and contrast so you can kind of see how these systems are different.
So let's dive right in. Let's start with Dave Ramsey's baby step number 1, which is save $1,000 for your starter emergency fund. That doesn't sound like bad advice. That's not bad advice. It's actually really good advice when it comes to building up. And if you can do this, you actually set yourself up far different than a lot of your peers.
Yeah, I think this is a good start because we've seen every year Bankrate comes out with their stat that approximately 60%, I mean, this current year it's 56% of Americans can't even come up with $1,000. But here's where I think we're a little different than Dave. What I'm looking for in that step 1 is how do you keep your life out of the financial ditch? Meaning what can come up and come your way that derails your ability to even start the wealth building journey. And that's typically going to be something that's catastrophic. The good news about catastrophic concerns is you can buy insurance to cover those things. So our step 1 is make sure your insurance deductibles are covered. So you'll list out all your different insurance deductibles, and whatever the highest one is, that's what you need to save to for your step 1 of the financial order of operations.
And the chances are it's probably going to be a little bit higher than $1,000.
Yep.
So again, ours is a little bit different than Dave. So then when we move into baby step number 2, Dave says that you should pay off all of your debt except your house using the debt snowball. And for those of you who don't know, debt snowball means you pay off your lowest dollar value debt first, and then you go to the next lowest and next lowest and next lowest. You don't pay attention to interest rates at all. We have a different view in terms of how you think about satisfying debt, but also building wealth and wealth creation.
Yeah, this is where this thing is starting to go off the rails a little bit, is because all of my financial meetings are like, this is why I love the Money Guy show, is because you guys get it. Because I'm just so excited. If you're watching this content, you're in your 20s, 30s, and 40s, hot diggity dog, because we're actually going to show you how you build some wealth. And one of the biggest things you can do is actually recognizing in step 2 of the financial order of operations is loving that free money from your employer match.
That's right. A lot of us work for an employer where we actually get a match on our retirement plan contribution. So if we put $1 into our retirement plan, our employer will also put $1 in there for us. Well, while it sounds great thinking about $1 for $1, it really helps if you can think about the long-term picture. If you've been listening to our show for any amount of time at all, you know we have this idea that $1 can turn into $88 for a 20-year-old by the time they get to 65 if you let compounding interest do what compounding interest can do. However, if you're someone who's participating in a 401k with a match, it gets even better. Instead of your $1 turning into $88 for a 20-year-old, your $1 with that employer match can actually turn into almost $177 by the time that you get to retirement.
But it's not just what it can become. I want you to see what the drop-off is. If you look at the visual here, look at this. For a 20-year-old, $1 with a dollar for dollar match has potential to become $176. For a 25-year-old, so only 5 years has gone by, it drops down to $88. For a 30-year-old, it drops down to $46. Do you see how fast this opportunity is just slipping away from us? So if you wait a year or two until you pay off all your credit card debt before you take advantage of that dollar for dollar, that 50 cents on the dollar, which is 50% guaranteed rate of return, or dollar for dollar, 100% guaranteed rate of return, you have lost out on a lot more than you probably recognize.
Now, we don't like debt. I mean, the very next step in the financial order of operations is to pay off your high interest debt. And we can think about credit cards or consumer loans or store loans. The reason that we like getting the employer match first is that no matter how punitive that credit card debt is, no matter how punitive that auto loan is, the chances are the employer match is going to be much more generous. So 100% rate of return on a contribution on a match can trump a 19%, a 20% credit card rate. It's just a matter of getting the most out of your dollars.
Yeah, I mean, might seem somewhat contrarian, but look, we do know that it is predatory when somebody's charging you 19 to 20% interest rate, especially when you're hoping you make 8 to 10% long term on your index fund investment. But that is just how good that employer match is. So we thought about it. We did the math on it. We thought about where you're on the wealth building versus the keeping wealth journey. And this is that much of a priority. So if you're good with math, you recognize this is a no-brainer. Get that free money from your employer and then focus all your effort on paying off that high interest credit card debt.
And then once you get that high interest debt paid off, then we move to our next step. For Ramsey, when you look at his baby steps, he says save 3 to 6 months of a fully funded emergency fund. Ours is a little bit different. Our guidance is slightly different. Ours is determine just exactly how big your emergency fund should be, because it's not always just 3 months or just 6 months, depending on where you are in your financial journey.
I mean, we talk about, once again, it's rainy day done right, and the fact that obviously a person who's 25 years old is going to have a different emergency fund than somebody who's 55 or 60 who's quickly approaching retirement. It's once again back to differentiating between wealth building versus keeping wealth in your financial independence. And we do have a separation there because it's not uncommon. We're very much like Dave with 3 to 6 months for a lot of your wealth building years. But as soon as you're close to retirement, we actually expand that out to 12 to 18 months because what we're thinking about is making sure you can weather whatever volatility comes your way from the financial markets.
Now, what I think is so interesting, Brian, is how many folks don't do this. When you look at this data from Bankrate, this came out in 2021, it is amazing how many folks don't actually have a fully funded emergency fund. I mean, if you look at this, the number of folks who say I don't know was 5%. And by the way, don't know is just code for I don't have an emergency fund. Then there's another 25% that say I have no emergency savings. And then 26% of folks say I have less than 3 months. Most people are not even making it past either one of the programs, whether it's the baby steps or it's the financial order of operations, past this step because they can't get the risk measure in place to the degree that it needs to be in place.
Yeah, so I'm with you. I think that both systems, whether it's baby steps 3 or financial order of operations step 4, they're both going to put you in a pretty solid place. So a check mark for both of them.